All right, guys, what's going on? It's 8 o'clock right now, and I think we have a few people in the room. I'm going to give everyone a second or two to get situated, to get acclimated, and then we'll begin. And if you want, I do have a comment box up on the other screen, and feel free to introduce yourself. Make sure that you give me some feedback as far as the audio goes. I want to make sure that you guys can hear me to begin with. Otherwise, this would be a damn shame if we got through the entire thing and realized that the audio wasn't working. Which, in my last live streams, has been an issue, where I've gotten through about 5 minutes into the stream before finally giving up on my new microphone and going with the generic, in-the-box version that came with the computer. So if you could hear me, just give me some feedback. Type yes in the comment area. Make sure my audio bitrate is proper. Let's see. Should be all right. Let's see, audio bitrate, yeah. Oh, good. Okay. I was really worried for a second because last time I did 2 live streams, I was just talking to myself for the first few minutes. Like I said, pain in the butt. So, Bitcoin to the moon 2020. Yeah, that would be ideal. But what's everybody's idea of the moon, right? That's the one thing that once you break an all-time high, it's really, from that point on, it's price discovery mode, and there's really no next area to look to. Everything's looking really good lately. The entire market is moving up, which is a good sign. So, again, I wanted to give everyone a second to settle in. We'll start in about 2 minutes. The entire market right now is moving up, which is excellent because normally you see that one asset will appreciate because another is suffering, right? So sometimes we'll see that alts will appreciate because Bitcoin is declining, or we'll see that Bitcoin will do well because it is receiving the inflows from alts. And right now we kind of have that situation where they say that a rising tide lifts all boats, and that's essentially what we have right now. We have, if you look at just the entire crypto market cap, which is worth paying attention to, right? Some people make a mockery of charting things like that, but it's essentially, it's like you're looking at the vitals of the market, right? This market is the size of some singular assets on the S&P 500, rather than the S&P 500, Dow Jones, or talking about any large cap stocks. So it makes sense to pay attention to the entire market cap, although Bitcoin, ETH, Litecoin, a lot of these majors pretty much represent 99% of it, right? So in this webinar, in this live stream, I'm going to be fielding questions. I do want to go over the platform that we're looking at right now. We are looking at Bybit, as everyone should know by now. This is a derivatives platform. So this is not where we trade spot Bitcoin. This is where we trade derivatives. All right. So in this case, an inverse perpetual swap. This is like a synthetic future. There is no expiry. All right. No real settlement. There is a funding mechanism that occurs every 8 hours. And that is essentially an incentive in order to keep the spot price and the derivatives contract in line. All right. So it's similar to if you're opening up a margin account on maybe a spot exchange or any other exchange. We're talking about traditional assets. If we're opening up a margin account, trading equities, it's similar to the interest rate, all right, except it's not nearly as painful and it doesn't get nearly as high. It does punish anyone, though, who does use a small amount of margin to control a large notional position, right? Because this funding is sort of like your theta or your time decay if you were trading options. So there is a little bit of this theta decay or this chewing into your the position, the margin that you put on to open up the position to control, if you, like I said, are controlling a large notional value, because you're paying the funding on the notional value of contracts that you're trading. So this is not a webinar to really go over everything on Bybit. By now, I assume that you guys understand what a limit order is, what a market order is. Okay, a market order, we're taking liquidity. So if we are using this right here, we are takers, all right? We are taking liquidity provided for us by anyone who is currently using a limit order, by market makers, who are happy to provide and bid an offer for you to slam into, right? They don't want to get run over by you. So hopefully they provide a bid that is tight enough, or an offer that's tight enough so that you're going to step into it, but not tight enough to where they're going to get run over. Okay. So a market order, you're going to be taking liquidity. Okay. And because you're taking liquidity, because of that convenience of being able to enter into position, and if you are not trading any massive size, all right, you will incur slippage, but if the book is dense enough relative to the current price, this is sometimes an effective way just to absolutely make sure that you get into a position. When the cost, or rather if you're not transaction cost sensitive and you're just doing this to try to get into something quickly because you don't really have any other opportunity to place a limit order, when you could afford to pay this cost and you can afford to incur this cost, you're paying the cost to take liquidity, all right? Which again is something that you need to keep in mind, because trading is very difficult. Being profitable in trading is not nearly as simple as some would make it seem, all right? You can be profitable if you were trading in a vacuum, but if you don't consider transaction costs and how they eat into your overall profit, then you're really missing out on a really important factor, or you're really overlooking a really important factor. So that's your market order. You're going to be taking liquidity. So if I am lifting the offer, I'm going to be taking liquidity from the ask side or the offer. All right. If I'm hitting the bid and I'm selling aggressively, I'm going to be hitting into the bids, which are resting limit orders to buy. So that is when you're taking liquidity. I'm going to be paying to do that. Now, a limit order is when you're going to be providing liquidity, and this is why you receive a make or rebate. Okay. You are going to be paid essentially to provide liquidity to the exchange. Now, what this means is that essentially to get a fill, you have to actually step in the way against the direction the price is moving. All right. So if I'm looking to get into a short position and I'm going to use a limit order, I have to accept that in order to be filled, price has to be moving up against me. All right. Does not provide you with the same luxury that using a market order does. It does not guarantee that you get in. It just guarantees the price. All right. So you might not necessarily be filled at that price. A market order guarantees exception. A market order guarantees execution, but does not guarantee price. You're going to get whatever is relatively close to the current price, depending on the level of density relative to that area as well. So if there's enough Bitcoin to fill your order, enough orders to buy or orders to sell, depending on what direction you're taking, then you will be served adequately. Now, conditional order types, all right, these time and force order types, these conditionals rather, reduce only, post only, and close on trigger. These are what we're going to be talking about, because these are the features that are somewhat either misunderstood or for some reason people are just not taking advantage of them. So when we're talking about, for example, the first thing I want to get into, and I had a few questions on Twitter and we'll get into those. All right, so post only. What this guarantees is that if I'm posting a limit order, say I'm posting a limit order right now for 10,404. I want to place a limit order to buy, okay? So right now that's where we currently are, all right? The mark price is going to liquidate you, but currently the last traded price is 10,404. So this is within the money right now. This is, and I'm not talking about in the money as in options, but I'm talking about it's within the current bid and offer. All right, so current bid is 10,404. Current offer is 10,404 with 50 cents. So we have a 50 cent spread. All right, currently the bid is being hit right now. So the last traded price is right at the bid. Now, if I was to place a limit order right now and I want to guarantee this price, let's say I have 100 contracts to buy right now, and I want to place a limit order to buy at only, let's say 10,400. So if I right now press this button and the order executes right away, we'll see that this order will be placed on the book. It'll be placed down here within this portion of the depth. Okay, so within the order book, I'll be placed down there, and I successfully placed it. It's a limit order right now. It will guarantee my maker rebate. All right. But as we all are familiar with this by now, there is often a ton of volatility, and the environment is not nearly stable as much as we would like sometimes when we're using a limit order. So what happens is you could be using a limit order where your intent is to guarantee price, and what happens is, as I'm going to place this limit order for 10,400, let's say that the market is moving rapidly at that time and price actually ends up dropping below that. So by the time that I am able to execute this order, say in between this time of me clicking confirm, price has actually dropped down and it's now at 10,390. So at that point, I'm executing an order to buy at 10,400, which means I'm buying over the current offered price. All right, if the offered price is 10,000, let's say 390 and 50 cents. So at that point, I become a taker immediately. All right, my order gets executed as a market execution, even though I set it up as a limit order, because I'm buying above the current limit price, or rather, I'm buying above the current price. Rather, the current, in this case, the current price is 10,404. Let's say if I put this in and my intent was to get, before the market moved, my intent was to get filled, all right, at 10,405. Okay, if I go place this order now and the current price is below this, I'm going to go buy, and it's going to reject my order. All right, so we could see that this order was rejected. It's been canceled because when I have post only, this guarantees that my order is only put through as a limit order, that I guarantee the rebate. And what this means is, during a period of heightened volatility, if I have this selected, if the price moves rapidly in between the time that I'm going to execute the order, then I will not accidentally incur the cost of being a taker. All right, my order will be rejected. So this is very useful. Now, obviously, this is very useful because if you're really keen or intent on placing a limit order, this guarantees that you're only going to place a limit order. But the more beneficial aspect of this is to anyone who is a scalper. So if I'm a scalper, I tend to have a higher hit rate, a lower risk to reward, or in this case, lower R multiple. My expectancy is a little bit lower. I anticipate getting less return maybe per trade than someone who's a swing trader or position trader. I'm trading more frequently. I'm, in this case, expecting less return than, let's say, maybe my return would be somewhat along the lines of risk to return of 1-to-1, which is not attractive if you don't have a high hit rate. So this type of system that's taking small bites is transaction cost sensitive. So they absolutely want to be, and more often than not, okay, depending on, again, if they can or they can't incur the cost of a market order, they want to be receiving a rebate, all right, especially if they're trying to jimmy rig a market making system on their own, okay, where they're just trying to provide a bid, provide an offer, and capture this small amount of volatility between a short spread, right? So they want to make sure they get paid for that, okay? They don't want to be, in this case, run over accidentally, and if they're dealing with $30, $40, $50, $60 rotations, all right, they don't want to execute an order that might be more than half of that, because at that point, the cost of that trade alone can really throw off any type of performance that they expected. All right, so especially if this is a higher frequency trader, a higher frequency system. So guaranteed execution of a limit order or rejection. That's when you're going to use post only. Now, reduce only. This is something that is unique to the derivative platform, because if I say I'm currently in a long, all right, or say I currently have a long and I have a take profit. So let's say that I buy long, market order, in this case, say market order, 100 contracts, buy long, using cross. All right, that means that it's taking my entire portfolio to apply it as margin. All right, instead of isolating it. This is dangerous because you can liquidate your portfolio. You have to use a stop in this case, and you always should use a stop, period. Although there's arguments for not using stops, I would just say if you're a newer trader, start off on the right foot, okay? So the same way that when you learn a bicycle, they don't tell you to do wheelies right away, right? You know that they can be done, All right, you've seen people incur the risk, but you don't start off that way. So, and this is just all on the. This is just the purpose of this is just to keep it real with you guys. All right, there are times when traders, even professional traders, do break their own systems. There are times when they skirt around the rules that are so often prescribed. So, buy long right now, 100 contracts. Let's say that I want to have a take profit, and I'm not executing a stop in this right away. Although this is what makes Bybit great, is because this is what makes Bybit great, is that I could actually put on my stop right away where I don't need to worry about putting on the reduce only function. So in this case, let's just say I'm placing an order to long, and I have a take profit that for my margin would be 100% away, or for the amount that I have 100% away. So 10,500. So now I have a take profit on the book. All right. Now I want to put a stop on. All right. Let's say that I want to put a stop on, and I'm considering, all right, I have a position open for 100 contracts. So yeah, I'll just set a limit order, which will be a stop, right? So I'll set a limit order at, in this case, my stop, I want it to be at 10,334. Or let's just try to keep this as appropriate as possible. Let's see, my distance to my target is 1% away, so it's really suboptimal, but let's just stick with actually a 1-to-1 normal risk of 1%. Again, this would not be position sized properly in this case, but my stop right now, let's just say that, just for even number's sake, all right, that my stop will be at 10,300. So 10,300. Now I'm going to put this order on, and my intent is to get out of the position that I'm currently in. All right. So my intent is to get out of the position that I'm currently in. Okay. Confirming it. It's telling me that I'm going to be using the oh, I just closed out my position actually, because there we go, because I actually was in that current position. So let's redo this. All right. If I'm currently in a long, okay, here we go. Currently long. Well, in this case, I'm actually always going to, we'll talk about why this actually occurs. All right, just so I clear this up so I don't waste time again going through this entire thing. So take profit and a limit order that's on the books. All right, when I have a take profit on the book, let's say that my order moves up through my take profit. Okay, so my order moves up through my take profit. Okay, if I have a limit order on the book that is, let's say that in this case, it's, for example, I'm using a trigger order. This is a better example. If I'm using a trigger order and it is to open up a limit, okay, if my intent was to have that position on to stop out the current position that I was in, okay, if my take profit is hit with the order that I'm currently open in, and this is left on the book, it's going to be an order that will open up a new position, in this case a short. So if I don't have reduce only, so if I don't have this open, all right, this will be taken as an order to potentially open up a position. So in this case, I don't want price to come into this and open up a new position. I'm going to make sure that I put reduce only on it. All right, so this is to execute an order that will actually take me out or reduce my position size rather than ever increase it. All right, so this is important because there are times when, and the same thing goes when you use a close on trigger. There are times when an order can be left on the book, and if this order is left on, this could potentially open up a new trade for you. So you have to make sure that you have these conditionals, or sometimes they're called contingent order types. You have to make sure that these are selected. Now the benefit is that this is actually already built in, and that's why when I just used that before, it was unnecessary. This is actually built in. If I'm going to be using a market order and I'm using this template, so better example, if I'm using this template and I'm buying long, okay, I just set this right away. So I set this right away. I'm going to use this to make sure that in this case, okay, last traded price, all right, stop loss 5% away. Now this is already built in as a reduce only order. So my stop is not going to open me up into a new position. So if we come up to this position at this point, we hit take profit, this stop is immediately going to be taken off the book. So I don't have to be worried about being adversely or accidentally rather entered into a position that I did not intend on entering. All right, so these are two things that are not frequently talked about or not frequently understood. More or less, more often than not, rather post only. Okay, post only is something that I think that more traders would actually be able to should be taking advantage of to try to capture that rebate and to try to and to make sure that they're guaranteeing that they're not accidentally, like I said, during periods of heightened volatility, entered into a trade through the use of a market order rather than the use of a limit order. All right, if their original intention was to use a limit order. Now, the conditional order types, all right, these are where you can set triggered orders. So again, there are times when we are not very certain about where price is going to be. Maybe price is more or less moving sideways, or during a period of, let's say, compressing volatility. You could look at something like ATR, see that the ATR is very low. All right, look at something like Bollinger Bands. The Bollinger Bands might be very tight. Anything that is showing maybe a diminishing volatility over time. All right, you could spot this by just eyeballing it more or less. You often see when price is really compressing, when we're kind of confining ourselves to a tighter and tighter zone, or rather range. In this case, you could use conditionals actually to put on what is similar to an option strangle, all right, or an options straddle, all right, depending on the level of volatility you're expecting. Okay, now the benefit of this is that you don't have to pay any premium when you're trading on the futures exchange, okay? But again, when you're using this, it does require you to be nimble, because if you're using this type of order, you're not going to be able to immediately have a stop position put on, although you will be able to capture a very impulsive move if we do resolve, far to the upside or far to the downside. So if I wanted to do this, I could bracket, let's say that I wanted to, for example, I want to be in a limit long if we break above 10,550, okay, and for 100 contracts, right, so let's say 100 contracts, I want to be limit long, or rather market long if we close above 10,550, so this is, this case, right, so now we see we have a conditional on the book. Okay, so we're semi-bracketed. We could actually move this down and change it now. Say I want to put it right above this high. All right, so the high of this current range. All right, we might get triggered while we're doing this. Now I want to set a bracket capturing downside movement. So in this case, let's say that I'm expecting a stop run if we were to cross below maybe the second low in anticipation that we might have a cluster of stops. Okay, because since we have a series of higher lows. All right, let's say that in this case, 10,296 is my threshold, or rather the barrier that I'm anticipating if we break, we are going to get follow through in. So in this case, I want to sell that break. All right. So now we have two conditional orders. Okay. If I was to have, in this case, I actually did have this one of these set as close on trigger, this would not be in order to open up a new position. This would only be in order to stop out this position. All right, so in this case, if I was entered in long, all right, and for the most recent one, I had close on trigger, all right, at that point, I'd be stopped out. So this is actually how you can set a stop, all right, pretty easily. So you go to limit stop or a market stop, depending on what type of execution you're looking to have. All right, and this is going to make sure, again, similar to the reduce only, that you're only taken out of a position, rather that the contract value is decreased rather than increased accidentally. So again, this is similar what I just showed you. Rather, what I just showed you is similar to what you would see if you were trying to play some type of long volatility move, all right, in an options play. Now, this is a little bit dangerous, obviously, but this is just one way that you can use a conditional order type to, again, bracket prices. But this is how you take advantage of, again, what is known as a stop buy, all right, or a sell stop. Okay, in case we're looking to take advantage of a breakout. Because there are times when you cannot use a limit order to enter into a movement because you're just not going to get a pullback. Again, you need price to come at you. And if price is moving upward, then, for example, you're not going to be able to take advantage of a limit order. All right, does everyone hear me properly? Because someone just said your mic is coming through twice. Sounds like there are two of you. No one else is complaining. Or not complaining, excuse me, no one else is saying that. Well, one person said it, but just make sure that everything is good. Okay. Let's go to the settings. Audio. Everything should be fine. Microphone. All right, I'm just going to continue. I hoping it sounds all right when we have it's published and recorded. Can everyone hear me clearly, though? If you can hear me clearly and you hear what I'm saying, please respond. Otherwise, I will just continue. %80 good. I'll take 80%. So maybe I'll just turn down my mic a little bit. Let's put on these settings. Sound. Let's go to mic. Device properties. Maybe I'll turn this down a little bit. Okay. Well, we can deal with a slight echo. All right, so I had a few questions on Twitter. All right, and then I'm going to field some of your questions on here. And I want to make sure that you guys have a really strong understanding of how this platform works, what the purpose is. Now, we're on the testnet account right now. You could use this testnet account, again, to just practice trading. Right? It does take out one of the most important aspects of trading, which is having skin in the game. But obviously, the derivatives platform, what it allows you to do is to mitigate counterparty risk. So rather than putting all your Bitcoin on an exchange, right, you could put a portion of it and represent your off-exchange amount. So you use the leverage in this case. You can use the leverage to increase your exposure to your normal off-exchange holdings, spot exchange holdings, all right, in a way that doesn't require you to completely expose them to the exchange. So on a spot exchange, again, you've heard the concept of not your keys, not your Bitcoin. When your Bitcoin is on the exchange, if something is to happen to that exchange, you are stuck with the bill, right? And not the bill for anyone else, but your Bitcoin is pretty much gone, okay? The benefit of using leverage is that I can increase my exposure, all right? I could take 10% of my Bitcoin, put it onto the exchange, and represent a full Bitcoin by using something like 10 times leverage. Now, the benefit of this also is greater capital exposure. So I can put on multiple positions, all right? I could put on a healthy position in an asset, put on another position in a different asset, again, by divvying up the amount of Bitcoin that I'm using to represent that position. So I'm going to be using leverage to employ that position. Leverage should not be necessarily used to gain extra exposure. We understand that is how more often than not traders are using leverage. More often than not traders are using leverage in, again, a very degenerate fashion. They're upping their exposure beyond what they actually have. So they're taking something like, if you use the example of 1 Bitcoin, and they might apply 10 times leverage to be trading on behalf of 10 Bitcoin. So if we're talking about where Bitcoin currently is, then they're trading on behalf of, in this case, $10,000 to $100,000, right? So $10,000 to $100,395, all right, or $100,000 in this case from the original $10,000. So that's not necessarily the smart way to use leverage, all right? That's why leverage should not affect your position size, okay? When you're using leverage, all right, your leverage is going to be, so if you're using cross, it's going to be adjusting the leverage based on the amount of money that you have, obviously, in your account balance, all right? So if you are trying to represent a larger portion, you're going to be using more leverage, all right? In this case, you're going to be exposing your account to potential liquidation. If you're not using a stop, again, this is what ultimately will happen if the mark price, all right, passes through your liquidation price, okay? We have a mark price, we have an index price, and we have a last traded price, okay? So the last traded price is where we currently are trading, all right? The mark price is the current exchange price with consideration of funding, and then the index price is a compilation of oracle prices based on spot exchanges, all right? So, and they use a time-weighted average price from these spot exchanges, all right, to make sure that they're using a dual price mechanism, okay? So, again, if you don't have a dual price mechanism, you could be subject to manipulation in this case. So the first thing I want to talk about, someone said, what is the effect of changing leverage on positions? Okay, what is the effect of changing leverage on your liquidation price? Okay, so the more leverage that you use, all right, the closer the liquidation price is going to be. Okay, so if you're using high leverage, you are going to be increasing or rather decreasing the space between you and your liquidation price. So this is why if you're trading with 100 times leverage, your liquidation price for that position is going to be just under 1%. So if price moves adversely against you 1% and you're using 100 times leverage, okay, you are liquidated. All right, for 50 times leverage, it's roughly 2%, all right, and so forth. So the more leverage that you're using, the tighter your liquidation price is going to be. You have to think that by using more leverage, you are taking the amount of capital you have and using it as collateral to represent a larger portion. So the window that you have for price to move against you becomes smaller and smaller, all right, because you're using a small amount to represent a larger amount. In this case, you're using this as collateral. So you're using your margin as collateral, okay? So you're borrowing, right? Now, another question is for trailing stops, okay? And this will be a time for some of you guys to start asking questions. So trailing stops. Someone asked, this was from Matany on Twitter, trailing stops, and is there a clever way to use it? So when it comes to trailing stops, a trailing stop is essentially a volatility stop. But if we're putting on a trailing stop for now, let's say, for example, we are currently, let's look at the daily, because the daily does not look attractive right now to put on any type of swing position, right? If we're looking at the daily, what do we want with any type of swing position? We probably want some type of substantial pullback from where we're sitting right now, or considering where we're sitting, we're at least going to be putting a position on if we overtake the resistance that is currently serving as resistance. So we would want to see some type of action from this point. All right, I wouldn't want to put on a larger swing position right here, put it that way. Okay, so when you are putting on swing trades, when you are putting on larger, more trend following positional trades, okay, you should be using some type of volatility stop. So there are different ways to use a volatility stop or to sort of incorporate a volatility stop into your position. And the concept is that you're taking in the market's volatility into determining when you will be stopped out. So one instrument that basically is a calculation of the market's volatility is ATR. Okay, so ATR is your average true range. So this incorporates the average range of prices depending on what your setting is. It might be over a 7-day period, it might be over, if it's standard, it might be over a 14 or 12-day period. All right, and this is basically your status quo for those days as far as what you can expect within the normal standard deviation of behavior for price to move within a range. Okay, so anything within this obviously is par for the course. All right, it's expected. All right, it is. There's no reversion to the mean trade until we fall outside of this. All right, this is what your Bollinger Bands will likely incorporate. This is what Kelter channels will likely incorporate. And when you're using a volatility stop, it's best to use something like an ATR, okay, or to incorporate ATR and rather a multiple of it. Another way to use a volatility stop is to use a moving average. Okay, this is another popular way. You might use something like a 10 period or a 20 period. But when we're using a trailing stop, I would say to incorporate ATR. So a trailing stop, if I'm going to put a position on right now, and this doesn't matter because we're on the testnet, let's say I'm going to put a position on for 100 contracts. I want to be long. I'm going to get in right away. I need to get in this position. It's getting away from me. Okay, and I want to put a trailing stop on. So in this case, I have to be in the position first because I'm using a market order. All right, I'm in the position right away. All right, now I want to put on a trailing stop. Okay, but I'm not really sure what the best trailing stop is. When I put on a trailing stop, what it's going to do is it's going to maintain a window, rather a distance, from where we currently are. As price moves up, it's going to maintain that buffer. When price begins to move down, it's going to stop. So it's sort of like a catch. If you're climbing, all right, it's sort of like one of those protective stops in anything, one of those latch mechanisms that can move forward, but once you try to go back, it cannot go back anymore. So 10,000, in this case, my USD stop will be $50 away. So if price moves $50 below where we currently are, I'll be stopped out. Now, if I could change this now, I'm going to put it to actually more of a buffer. In this case, it's going to be, in this case, my trailing stop is $196 away. All right. So it's $196 away. Okay. And if price moves up, it will trail it by that much. All right. If price begins to move down, it stays where it is. So if price goes up, I'm trailing it. If price comes down, it stays where it is. But it's kind of arbitrary to do it that way because what is $196 relative to where we currently are? So in this case, it's actually better to use something like ATR. So what I'll do is I'll actually go to ATR. Okay, we'll find out what the ATR is, let's say for the 7-day period. All right, so actually this one pulled up the 14-day right away. All right, we're looking at a 4-hour chart, but let's say that I want to do this for the daily. Okay, so this is a strong trend. I want to make sure that I incorporate the normal volatility of this trend. It's pretty normal for this to move anywhere under $360 and just to be par for the course. So a $360 move, let's say that we have that throughout the duration of the day, no reason to be upset. All right. The proper type of volatility stop will be a multiple of this. So in this case, I'm going to say that the best idea is maybe to use a multiple of 2 times ATR, all right, for a trailing stop. So what I'm going to do is I'm going to look at the current ATR. All right, in this case, it is 328, and let's just roughly double that, and we have, let's say, 656. So 656 is my 2 times multiple of the current daily ATR, and now my trailing stop incorporates volatility. All right, so it incorporates what is outside of the normal standard deviation of events, and in this case, what's going to stop me out is a move that is not par for the course, that is not the status quo, that might be cause for alarm. If we have a move that is $600 out of nowhere, I want to be out of this trend. That's abnormal, right? Now, this is the dangerous part. That's abnormal to me because I'm taking in volatility, but mean reversion traders might be all over that. So it's a matter of time frames, right? You have multiple traders with multiple goals at any point within the chart. You never know what level you're approaching. If you're approaching a higher time frame zone, you could guarantee you're probably bringing in all participants. When you're within ranges, you're probably going to be more short-term oriented. You're going to have more mean reversion traders. You're going to have more of those short-term oriented traders as a whole. So again, this is going to incorporate volatility, and what I did was I took a multiple of ATR. Now, commonly what I will use is I'll use anywhere from 1.2 to 1.5 of the current ATR. And again, if you go down to the 4-hour now, it's going to be taking the true range of the 4-hour period. So like any other indicator, this is going to incorporate from periods, individual rotations, and not keeping in mind what the overall day is when you go down. So it's going to incorporate now on the 4-hour period what the ATR is based on 4-hour rotations. So that is how to set a proper trailing stop to incorporate volatility. And I went over post only and reduce only, okay, and how these allow you to receive a rebate. So that was another question. Another question about funding. Okay, so funding is not a ratio, all right? It is, think of it like an incentive mechanism, okay? If you're in a position, you're paying funding, all right, you could likely expect that the position you're in has been the popular position, all right? It has been, in this case, let's say we're looking at current funding. It's positive. That means that longs pay shorts, all right? We're going to be paying 7 basis points, currently 7 basis points to anyone who's currently in a short position. All right, so think about this as your interest. And a perpetual swap is unique because it doesn't expire, but the annualized time decay, if you consider that this was to add up over time, can be quite large just to keep a position on. So I do advise that you do keep this in mind, because if you do close out your position before the funding interval, before this expires, you don't have to pay. And that's actually what is the purpose of the funding mechanism. All right. So the funding mechanism can actually be used to gauge sentiment, because this does show what side of the market is more aggressive. So when you're seeing, when we're in a period where in an uptrend and the dominant, the macro trend is an uptrend, you know, what's the dominant position going to be, right? Most people want to be long at that point. You're going to have aggressive longs. You're going to have aggressive taking, right? This is going to be, there's going to be more takers than there are makers, all right? And we're going to be talking about longs taking liquidity. So we have longs aggressively hitting the offer, or rather lifting the offer. There's likely going to be a positive funding rate. And this is an incentive mechanism to move back price, to move the derivative price back to the spot price. Now think of how this works. When the dominant trend, all right, is aggressive long, all right, when the dominant positioning is aggressive long, you're having the derivative swing out of line with the underlying, which in this case is the spot BTC or the index. Okay, now this happens because this is not a spot exchange, because this again is it's synthetic, it's a derivative, and we have larger notional values being traded. There's more gunpowder in these positions than on many of the spot markets, especially if you're talking about some of the larger derivative platforms. So in this case, price is going to swing around the index. All right, it's not going to come off of it drastically, but there will be a premium, there will be a discount, there will be this this basis at times, this negative or positive basis. All right. So it'll be a premium when it is above the spot price. It'll be a discount when it is below. All right. And you need these two to line up, though. Okay. The funding, the contracts need to, if you're talking about futures contracts, they'll expire. All right. So when you're talking about a futures contract expiring, over time, the spot price and the futures price will meet. All right, there's a reason why that there is a disparity between them to begin with when it comes to the cost of carry, when it comes to opportunity cost, when it comes to sentiment. All right, there's plenty of reasons why we might see a market in contango or backwardation, or where we might see futures be in a premium or a discount. All right, with relation to spot. But we can't have this on these types of platforms. This is a peer-to-peer exchange. This is an exchange where we're having something that is unique to markets, which is this perpetual swap. We need to keep the index and the derivative contract in line. So when the index is above, or rather when the derivative is above the spot price and everyone is aggressively long, how do we get the prices to align again? Well, you create an incentive to make people open up short positions. You create an incentive to make people close out long positions. So what you're doing is, if you're in a long position and you have a large notional long position open up, okay, 7 basis points can really add up over time. So your incentive is to close out your position before this funding rate, right? What happens when you close out your position? What happens when in aggregate, the cumulative effect of everyone closing out the position, price drops, right? Now, minus just longs closing out their positions they're currently in, what happens if shorts are incentivized? Let's say people are on the sidelines right now, and they're incentivized to open up a short position. Well, that's incentivized selling pressure, all right, because they're going to get paid that funding rate. So you see that this is an incentive mechanism to keep the spot price and the derivative price in line. But what it does give you an idea is when it is extreme, all right, there are certain mean reversion trades that you can take. All right, not getting into any strategies in anything, or rather in this webinar, but there are extreme values you could take advantage of. The same way we might try to take advantage of extreme premiums or discounts. All right, when you're talking about the perpetual swaps and you're talking about the derivative platforms, a lot of the times any type of short-term mean reversion trader can take advantage of this. And also some larger position traders, some people who are trying to look at the market as a whole on a larger scale, might look at any prolonged funding, whether it's favored to the upside or to the downside, as an indication of positioning in the market as a whole, right? And when we're talking about positioning, we're talking about potentially one side that is overcommitted over time, and that's exactly what we need for the market to move drastically in the opposite direction. So that's what the funding mechanism is. I think it's really important that people understand, all right, what this is. It's a combination of interest rates, all right, and funding and discount, all right. So think of this as, again, if you're in this position, this is your interest rate that you have to pay. And if you're currently out of position, this is something you could get paid. All right, this is something you could potentially make money on. You'll see that if you're in a position that is, for example, short right now, you'll see that every 8 hours you'll be paid. All right, depending on how large of a position you have open. So those are the questions I got so far. I want to open it up to anyone who might have any questions right now on the YouTube platform. I'm going to take a sip of my new bubbly sparkly water that I just bought. It's not a this is not an endorsement. There might be a little bit of a lag, but I'll give you guys a moment to ask any questions. So on these exchanges, the multiplier, it is 1. So you're talking about delta 1. So this is a futures platform, which does make it delta 1. Delta is the first derivative. All right, when we're talking about relationship to X and Y, are we talking about how much the derivative changes with relation to the spot for every point change in the spot? So in this case, it's delta 1. So one contract, $1. In this case, Bitcoin goes up by $1. All right, your derivative goes up as well. All right, I talked about convexity yesterday on the BlockRoots YouTube. All right, convexity has more to do with acceleration. All right, so the rate of change of delta. So if anyone has any questions about some of the things that I might have talked about yesterday, I don't see a lot of material on these. All right, convexity will affect your positions on these platforms, especially if you are trading the perps. So if you are trading these synthetic futures, convexity will be something that can either benefit you, depending on you being in a short position and price moving against you, or be adverse to you if you're in a long position and price is moving against you. So does anyone have any questions? I'm going to leave it open for a second. I don't see anyone asking any questions yet. All right. So we're going on, how many minutes are we going on right now? We are going on 44 minutes. Oh, you forgot your questions. That stinks. When I'm short means I'm betting on price to go down, yeah. Okay. So when you're short, it's not going to change your leverage. All right. If you are opening up a position, okay, so here's the interesting thing about trading on the derivatives platform, and I said long your longs. So when you are exposed to the derivatives platform, okay, you are already long. All right. So what this means is when you actually open up a long position, the margin that you're putting up this is something that's unique to trading on Bybit, for example, around many of the derivatives platforms in cryptocurrency, is that the margin that you put up is going to be margined in the asset that you're trading, which you don't have. Okay, when you are opening up a margin account trading equities, your margin is in USD. When you're same thing trading futures. Okay, you're not opening up a margin account trading gold with gold. You're not opening up a margin account trading oil with oil. Okay, you don't trade crude oil margined in crude oil. So the thing that makes Bitcoin unique is that when you're in a long position, okay, and you're just thinking about relationship to the dollar. So think about USD value. The position, if you're long, so if I go long right now, I have a tenth of a Bitcoin on this test net. So if I go long a tenth of a Bitcoin, right, $1,000, all right. Now, if Bitcoin goes up, my margin on the exchange and my Bitcoin on the exchange is going up. And in this case, if I open up a position, that is going up separately as well. So that's why you could actually be liquidated if you open up a position and it only goes down 50%, which is not only 50%, but people don't understand that when you open a position on the derivatives platform, even if it's just for the amount of money you have on the platform, at that point you are exposed to the derivative and the underlying already. So you actually have half of your derivative contract open with your margin, okay, with half of your margin, or rather half of your available balance. Right, for this math, rather for this, in this case, I have a tenth of the Bitcoin. So when your position is going up and you're in a long, your margin is going up in USD value as well, which makes it like essentially you are longing your longs. Now, when you are in a short and the position is moving against you, okay, and you're long, rather if you're in a long position and the position is moving against you, your margin is decreasing in value as well. So this is something that has to do with convexity, okay? In this case, when you're in a long, your losses to the downside are accelerating because not only is your position moving against you, but the margin that you have up, which is in Bitcoin, is going down in USD value as well, which makes any downside, in this case, be way much more adverse. All right, then if you were in a short position, because the opposite is true. If you're in a short position, and again, you're margined in Bitcoin, so if Bitcoin is going up, your position might be going against you. Let's say this occurs before you're stopped out. So, and this is why you have to put stops on. If I'm in a short position and my short is moving against me, and let's say it's still within my stop distance. Okay, when you're thinking in terms of USD, the position might be moving against you, but the USD value of the margin that you have is actually going up as well. So there's actually a diminishing, in this case, the rate at which you are losing value is decreasing. All right, so it's not accelerating. All right, so you're in this case you are losing at a decelerating rate. Put it that way. So the Bitcoin is going up, and your position is going against you. So it's mitigating some of this loss that would occur if you're actually in a long position, and the value of your Bitcoin, the underlying, is declining, and your position is declining against you. So it's like a double whammy. All right, of being on the wrong side of the market when you're in a long position with leverage. All right, with leverage. More unhealthy leverage you apply. This is why applying leverage in a degenerate sort of extra exposure way, okay, not consider position sizing, is very dangerous. If your system warrants that you can increase your exposure, that's another story. If you have a system that says that your stop distance, or rather, let's say your risk limit for a trade is 3%, and your stop, in this case, the proper stop for this trade is 1% away, then you can incorporate leverage to increase your exposure, because if you're stopped out at 1%, you're still only accounting for that 3% as far as your rules go, right? As far as your risk limits account for. So, let's see. Oh, thank you very much, guys. That's right. So that's why there is convexity on these platforms when it comes to being margined in Bitcoin. All right. This is a nonlinear futures contract. All right, it's not like a linear futures contract when we're talking about if we are margined in USD. All right, or in the case if we are margined in USDT. So nonlinear meaning at some point it's accelerating, right? So for every change in X, think go back to calculus, right? Not everyone liked calculus, but talk about for a change in X, change in Y, right? If that rate was constant and there's a linear change, then we see a change in X plus 1, we see a change in Y plus 1. In this case, let's say delta 1, we go up 1 for 1 for 1 for 1, right? When we're talking about convexity, we're seeing an acceleration in terms of that change. So for every increase in X, or rather increase in Y, X goes up more and more and more each time. So we're seeing that rate of change increase as we see a change in one of those values. So this is normally something that you'll talk about when you're talking about bonds, okay? Or if you're talking about convexity, you normally hear this conversation come up when you're talking about bonds and yields. Or if you're talking about options, it's referred to as gamma. And when we're long Bitcoin, all right, we are essentially Bitcoin. If you're considering Bitcoin like a call option, we're long gamma, right? We're long volatility, we're long gamma. So any other questions? Otherwise, we are going into about an hour. I think it's been really good so far. I just want to make sure that I field all your questions. I don't want to leave anyone hanging. Any question is good, right? There are no stupid questions. Everyone remember that phrase from their teacher in elementary school. There are no stupid questions, right? It is so important that you really understand the ins and outs of this platform, all right? Exactly how it works, okay? You're putting your money on the line, right? So when you are actually trading, you're putting your hard-earned money on the line. You really have to understand the instruments, okay? The same way that and that's why it's really important. What I would say is go on to the testnet and really familiarize yourself with this platform. All right, the same way that a pilot is going to clock a lot of hours in a sim before they ever take off. All right, you want to make sure that not only can you trade during periods of comfort, but again, especially when there's periods of heightened volatility and you actually have money on the line, your decision-making process can change a little bit, obviously. All right, it goes without saying that a certain level of performance, when you consider athletes, for example, success in performance actually comes down to being able to perform successfully under pressure. And when you have money on the line, that is one way to really activate a part of your brain that you don't often come in contact with if you're not in positions where you do have something at stake, right, or skin in the game. So other than that, I think that might be it. One of the things that I would advise is good till cancel, dialogue, fill or kill. Oh, excellent. I'm really happy that we got into these. Okay, I almost left these out. So these are time and force, all right? And Bitcoin is going up right now. These are time and force. Okay, so what that means is we are going to basically set the parameters in which we consider a position to be left on or closed out. Okay, so that might have been a little wordy, and I think I got myself in a tongue twister. But good till canceled, when you put a position on with good till canceled, if I put an order on right now and I want to, let's say I'm a larger position trader and I want to give you guys an idea of who might use this to. So if we're talking about I'm a larger position trader and I want to put on a position over time and I feel like the market's going to return to the monthly open over time a few times, right? So I feel like I found a good area to buy. I think that the market is going to spend a good amount of time here. I just kind of want to put the position on. I don't want to pay attention to it. I want to be filled over time. I'm going to leave this on good till canceled. So if I put an order on right now and I want to limit buy at, let's say I think price is going to come back down to 10,000. All right. And I want to buy at 10,000. I only want to buy at 10,000. I'm just trying to step away from this. All right, in this case, I put an order on and it's on good till canceled. All right, it's active. Currently, we're on down here. You can see this posted onto the chart, which makes Bybit really one of the exceptional platforms because it's great. You can move this up and down. During periods of volatility, price is moving away. Maybe I want to chase price up. I want to get that fill, but I want to make that rebate. So in this case, if price comes down to me and I have, let's say, 100,000 contracts open, okay, where I'm trading, let's say I'm trading 500,000 contracts, okay. I'm trading 500,000 contracts, and I don't think I'm going to get filled all at once, but I do think I anticipate I'll be filled over time, and I'm willing to let the position sit, okay. I'm not really worried about position filling a little bit now, a little bit later. I put on good till canceled, and what happens is, let's say we come into my price and I only get filled at 75,000 contracts. Well, I have 425,000 contracts left. I don't want to change anything. Price moves sideways a little bit, comes back down, fills me for another 100,000 contracts. Now I'm good in the books, 175,000 contracts. I have 225,000 contracts remaining that I want to get filled. Now you get the idea. I'm able to leave this order on, and it's not going to change anything, okay? It's going to remain on the books until I actually cancel it. So what this will do is allow me to basically step away, and if I'm anticipating price returning to an area over time, I'm willing to keep this order on the books. I'm not really worried about it whatsoever. I'm going to leave it on. I have to get out of it by canceling it, okay? So now I cancel the order. That's how good till cancel order works. It's going to stay on the book indefinitely. It can stay on for a year, right? This is how some traders, some more, let's say they're more geared towards filling a spot in portfolio, or they're more position traders. They're not day traders, not paying attention to charts. Maybe over time, they want to get filled within a range, right? So they want to, over time, get filled between $7,000 and $10,000. They might put on good till cancel orders and step away from this for a long time, right? Because they're anticipating that we spend some time here, but they might have longer term goals for Bitcoin, or rather long. No one should have goals because that's acting with certainty, but they might have longer term ideas for where Bitcoin might be. That might be well outside of the realm of the prices we're talking about right now. Maybe they consider it'll be a rounding error in the future. They just want to get filled at a certain amount of time, and they don't want to have to worry about it. Good till canceled, fine. Now the other order types are more conditional. Okay, and as far as conditional goes, immediate or cancel. If I put on an order right now for, and I might not get an example right here, but if I, because I don't have enough actually in the available balance, if I put on an order right here for 100,000 contracts, okay, and I have immediate or cancel on. I put on a limit order for 100,000 contracts, I hit it, okay. Now, immediately I'm able to be filled for 800,000 contracts. That's awesome. Right away I'm filled, but if I can't get filled for anything else, it cancels the remainder of the order. So I have this set at 10,000. So if I can get filled for anything at that price, I will fill that amount, and then the remainder that I cannot get filled for will be canceled immediately. Okay. So this ensures that I don't have a limit order that's left on. I'm only getting filled for that amount. All right. I'm not leaving that limit order on and getting half filled. I'm actually just getting from what I can, and then it's canceling the rest of the order. So it's not leaving a limit order open on the book. Now, the last one is fill or kill. This actually is pretty good for, again, we talked about post only. Fill or kill is good for scalpers as well. They might have a certain lot size that they have in mind. They might have a certain position size that they always work with. Fill or kill is going to make sure that I get filled or I don't, okay? I'm going to get filled for this position or nothing, nada. It's going to cancel the position right away, all right? So in this case, if I can't get filled for the entire position, all right, which shouldn't be a problem for me right now, all right, depending on where I currently am and how much I'm actually trying to, in this case, pick up. If I can't get filled for this, it's going to kill the order no matter what. It's not going to fill any of it. It's going to either fill everything or nothing, all right? And this is for people who are, again, are transaction cost sensitive, who need to get in at an exact price, an exact fill. If they don't, then the opportunity is lost. They don't want any part of it. So that's fill or kill. And any one of these, by the way, just thinking of this, if you actually hover over these, all right, it should show you. All right, so if you hover over post only and reduce only, it's actually going to show you what some of these mean, just so you have an idea if you don't remember what I've taught you right here. So that is the fill or kill, and I think that more or less wraps it up. Unless anyone has any other questions, I'll leave it open for a minute, give you guys a second, consider any little latency that might exist, and then we'll end up wrapping it up. All right. Okay, any other questions? What do we have right now? What do we have with Bitcoin? Okay, let's expand this a little bit. What are we working with? Where is, I need to put this auto on. That's what I need to do. Okay. All right, guys. Brief analysis, maybe? 4-hour chart. See, this is what I am suspicious of. And I don't want to get into any type of analysis, but grinding at resistance, no clear rejection, I don't know. This might be a surprise, although a lot of metrics do say that there are many long right now. Although this is, again, this is in a derivatives ruled market, and if we have inflows from spot right now, all this goes out the window and anyone can get run over at that point. Thanks, Ryan. It's been great. Thank you. I appreciate that. So it's been a pleasure. We're going to be doing more and more of these. We'll be doing them through Bybit. It's absolutely important that everyone takes these platforms seriously and everyone really thoroughly understands just how to use everything that you're looking at on the instrument panel, because that's what it is. It's an instrument panel. You are using an incredibly complex machine. You are putting your money into it, and you should absolutely understand not only how to use it, okay, to stay safe, but what parts of it to implement in order to put yourself in the best position, because you might have a good idea of what direction the market's going. You might be proper with your timing. But there are ways where you could actually shave off even things like a few pennies, or in this case, a few basis points, if you make sure that, for example, your orders are getting executed as post-only limit orders, right? So every trader should have an idea of how many fees that they're paying per standard size. So someone might have a standard size of, depending on your monthly volume, someone that might have a monthly volume of 50 million contracts, someone might have a monthly volume of 100,000 contracts, all right? And in your contract volume for that month, you should have an idea of how much you're actually paying in fees. I don't think enough people talk about that, because usually that goes out of the window. The transaction costs are not something that are often considered. Okay, it's kind of like, you're punching the ticket. Well, no, not really, because that's something that is absolutely of paramount importance to anyone who is trading in the professional realm. Okay, so my transaction costs are something that I absolutely focus on, because at any day, or rather at any point, that's money that I'm putting on the table that is essentially just taking away from any alpha that I might be pulling back. So if you're trading, you are electing to take part in something that, based on your own volition to get involved in, is saying that you are going to be beating what the market is returning. So regardless of just capturing beta, which would be just the risk of the instrument, all right, the amount of exposure with relation to a benchmark, so you might consider Bitcoin a benchmark. So normally traditional assets, we might say the unit of risk in relation to the benchmark. So if the S&P has a beta of 1 and we're trading a stock that has a beta of 2, you might expect that if the S&P moves up 1%, the stock moves up 2%. The downside can be exacerbated just as well, sometimes even more though. Often even more, especially when we talk about the relationship between alts and Bitcoin and that beta relationship as well there. But for example, you have to consider your transaction costs. Okay, so this has been a pleasure, guys. All right. As always, we're going to be doing we're going to be doing these. And as always, if you have any questions, feel free to direct message me on Twitter. All right. And that's that. It's been a pleasure. Everyone have a fantastic morning, evening, night, depending on where you are. All right, guys. Take care.